Hey everyone, I'm Tim Wills and welcome back to the channel. Intuitively, it does make sense to want to pay off your mortgage early. If we look at this mortgage calculator, we can see here that the home loan value is $500,000, interest rate of 3.8% and a loan term of 30 years. We pay a total of $838,000, $338,000 of that being purely interest payments going straight to the bank. So it makes sense that if you're paying that for 30 years, you're going to want to pay it off early so you don't have to pay all that $338,000. But this is where it gets interesting because not all money is equal. Paying $338,000 over the next 30 years in interest payments is not the same as paying $338,000 today. And that's because of the time value of money. Each year, your value of money decreases by about 2% on average because of inflation. So it creates this situation where the value of your home loan is increasing by 3.8%, but the value of your money is decreasing by 2%, and you can actually directly subtract inflation from your interest rate. So, in real terms, when inflation is considered, you're only actually paying 3.8% minus 2 equals 1.8% interest every year on your loan. The next thing we can consider is opportunity cost. As you increase your payments, your free cash flow will decrease by the same amount. What if instead of putting that extra money towards paying off your home loan early, you invested it in the stock market? Well, in theory, because your adjusted inflation rate is 1.8%, if you were able to achieve higher returns than that, you would be better off. And the great thing is the average yearly return of the S&P 500 is 7.5% when adjusted for inflation. It seems like a pretty simple question now then. All you're doing is comparing two returns. Would you rather a 7.5% return or a 1.8% return? We'll look at two different scenarios to show how this works in practice. Our base case is a $500,000 home and a 3.8% interest rate. In scenario 1, we pay off the loan in 15 years, which bumps our monthly repayments up to $3,653. Now with both of these cases, we're going to be investing the excess money we have left over into the stock market. Now for the first 15 years of scenario 1, there's nothing left over because we're investing all $3,648 into our home loan. And that's, I think, how you have to look at it. We're investing it into the home loan. So after the 15 years, we can then invest all the money, all that $3,648 straight into the stock market for 15 years. In scenario 2, because we're paying it off over 30 years, our monthly repayments are going to be slightly less, $2,329. That means we can invest the excess money for the entire 30 years. So we're investing $1,318 for all of those 30 years, unlike with scenario 1 where it's a larger amount but for a less time. Okay, so at the end of the 30 years, how does our investments look? Obviously, in both cases, we're going to have one house because that's the whole point of this. So in scenario 1, we have one house, plus we have $1,182,319 and, for good measure, 3 cents. That's how much money we're left with after the 15 years of investment. Plus, of course, we've paid off our house in full. Now, in scenario 2, we have also paid off our house in full. So we have one house. Plus, we have $1,691,795.96, which is a massive leap up from scenario 1, and it just goes to show the impact investing for all of the 30 years can have on your ending net wealth. Let's look at the total interest that we paid in both cases. In scenario 1, we paid $156,734.96 to the bank. That's how much the bank got from us for servicing our loan for 15 years. In scenario 2, we paid a whopping $338,723 for servicing our loan for 30 years. So despite the fact that this one here is over double the size of scenario 1's interest payment, we still had over $500,000 more in ending net wealth. So I think this is really important and goes to show the fact that you shouldn't be scared by this total interest number, because if you invest the difference, you can actually end up with a whole lot more ending net wealth. Now, there's actually one more thing that makes keeping your mortgage for 30 years even more beneficial, and it is the tax benefits. In a lot of countries, you can actually write off the cost of your mortgage against your tax income. So if for simplicity reasons your mortgage was $10,000 a year, you would only pay income tax on your yearly income minus $10,000. Or if it was a rental property, it would be your rental income minus $10,000. These favour the 30-year mortgage because you pay more interest costs over the 30 years and can therefore write off more tax. The reason I didn't include this in the calculation is because I didn't want you to go, oh, it doesn't apply to me, I don't know how to do that, and sort of just be gone with it. I've gone through the steps to show it is possible without having the tax benefits, but if you add the tax benefits, it's even better. Now, there are some exceptions to this 30-year mortgage idea that we've been talking about. The first one is about willpower. If you don't have it, 30-year mortgages probably aren't your thing. Having a 30-year mortgage is only a good idea if you're investing the difference. Otherwise, it's pointless. You'll end up spending it on frivolous things that aren't going to add to your ending net wealth. So if you can't commit to investing the difference, then you're probably going to be better off paying your mortgage down early. Then there's the sense of freedom that comes with having no debt, and this definitely shouldn't be overlooked. For a lot of people, having debt can be incredibly stressful, and for them, maybe paying off your mortgage early and getting rid of the debt is a good idea. This can also stretch to include people who are incredibly risk adverse and think interest rates are going to skyrocket, or people who think they're going to lose their job. Having no debt can certainly reduce stress. But for the rest of us, don't pay your mortgage off early. Interest rates are almost negligible by the time you account for inflation and tax benefits, and after that, you're far better off investing the money you would have put towards paying off your home loan early and putting that in the S&P 500. Remember, paying off your mortgage early gives you a circa 1.8% return on your investment. That's assuming you have a 3.8% interest rate, but investing in the S&P 500, adjusted for inflation, gives you a 7.5% return. With that said, thank you so much for watching. If you like this type of content, please do consider subscribing, and I'll see you back here next week.